America's economy is in a shaky state. Between $37 trillion in debt, volatile trade policy, and a brewing AI bubble, things are starting to slip. At first, that might sound counterintuitive. The latest figures show America's economy growing by more than 3%, one of the strongest performances in the developed world. But those numbers hide a deeper story. Beneath the national average lies 50 economies, each with their own strengths, weaknesses, and breaking points. And when you pull back the curtain to see how each one is really doing, a very different picture starts to emerge. Of the 50 states, only 16 are actually experiencing any economic growth, 13 are treading water, and 22 are actually seeing their economies start to contract. The cracks aren't everywhere yet, but they're quickly spreading. History has shown when one part of America's economy cracks, the damage spreads fast. And this time, those first fractures aren't showing up where you'd expect. The real question isn't if a recession hits, it's how deep it cuts and which states go down first. When Donald Trump first came to power, he promised to win back one group above all others: blue-collar workers. States like Wyoming, Arkansas, and Mississippi have some of the highest percentage of these blue-collar workers in the country. And even though bringing back these manufacturing jobs has become synonymous with Trump, America's industrial base has been gradually declining really since the end of World War II. Manufacturing as a share of GDP has fallen from about 25% in the 1960s to about 15% in the 1990s and just 10% today. Similarly, it now only accounts for just 8% of all jobs in the US. Despite that, it still makes up a big share of employment in these states here in the Midwest, and these are the ones that over the last 40 years have been hit hardest. Most economists see this as a natural consequence of globalization. By allowing free trade with other countries, Americans could import goods from other parts of the world with lower labor costs, and instead focus their efforts on more advanced industries like tech and science. And while this was great for the majority of the country, it did mean that in certain manufacturing states like Michigan, Ohio, and New York, there was a huge amount of discontent. Trump's main plan to fix this was, you guessed it, tariffs, making imports more expensive to push demand toward domestic goods. But the results so far haven't been great. The ISM's manufacturing index shows the sector has contracted for 7 straight months. And when you actually get into the data, the reasons for this are pretty obvious. Manufacturing relies on basically 2 inputs, labor and raw materials. If a country can get both of those on the cheap, then it's got a good shot at becoming a manufacturing powerhouse. The US obviously can't compete with countries like China and Vietnam on workers' wages, simply because there aren't that many Americans willing to work for 50 cents an hour. But thanks to the strong export infrastructure and some of the best rail and shipping networks in the world, they've been able to just about hold on to some of their old manufacturing base. The thing is, tariffs completely remove this advantage. Estimates by Goldman Sachs now suggest that 91% of the price of tariffs are being paid by US consumers and producers, and they've already started to push up the costs of these materials and components American firms rely on, wiping out the advantage the US had beforehand. The result is that since Liberation Day, the manufacturing belt alone has lost more than 40,000 manufacturing jobs. And in places like Pittsburgh, major steel mills are shutting down, and stories are emerging of former steelworkers now driving delivery vans or commuting hours each day just to pick up temporary shifts. To make matters worse, the Trump administration has also begun enforcing super strict policies on immigration. The idea of this was that by reducing reliance on foreign labour, it could encourage firms to train and hire more domestic workers instead. The problem is, doing this takes a huge amount of time and money, and it's even slower when there isn't a set of experienced workers to learn from. Some manufacturing states have relied on immigrants to fill a quarter of the roles in these industries, so it's a pretty big ask for these economies to try and rebuild when thousands of their workers are reported every month. But that's the exact situation that these states are now finding themselves in. You saw an example of this in microcosm last month, when ICE detained and deported hundreds of South Korean workers helping to set up a new Hyundai plant in Georgia. And this isn't a one-off. Similar stories are emerging across the country, construction sites halted mid-project, factories running below capacity, and farms unable to harvest their crops, all because the workers they rely on have suddenly disappeared. In a pretty brutal twist of fate, the 2 headline policies of the Trump campaign, cutting migration and tariffs, seem to have actually hurt the states that voted for them. But while the failures of these policies to prevent the decline of the manufacturing industry is well documented, what you might not know is that the effects of this have quickly spread to an entire different industry: agricultural states. Midwestern states like Kansas, Iowa, and South Dakota generate nearly a quarter of their GDP from agriculture, growing crops like soybeans and corn, then selling them on international markets. But in the last couple of years, the price of these crops has fallen by nearly half. Part of that is because global markets have been flooded. Countries like Brazil and Argentina have dramatically ramped up production, and thanks to having a cheaper workforce, they can get away with selling their crops at lower prices than US producers. But there's also another factor causing this shift. You guessed it, tariffs again. In response to Trump's tariffs, Beijing hit back with equal force, targeting US agriculture directly. China imposed tariffs of up to 25% on key American exports like soybeans, corn, and pork, and overnight some of the US's largest buyers disappeared. Some farmers are literally leaving their crops to rot in the fields, simply because there's nobody to harvest them. And states across the Midwest have reported upwards of $3 billion in losses from this alone. Even for the farms where it's actually profitable to grow these crops, it's becoming almost impossible to find people to fill empty positions. For decades, they relied on migrant labor to fill grueling positions that most Americans simply wouldn't be willing to do. But thanks to new immigration policy, farm labor shortages are now the worst they've been in over 2 decades, with some regions reporting vacancy rates above 40%. This has been devastating for states across the agricultural belt. In Nebraska, farm bankruptcies have jumped by nearly 30% in the last year alone, and places like Kansas and Iowa have seen a 25% decline in net farm income since 2023, forcing major corporations and family farms alike to shut down. Now, in theory, farmers actually should have had a kind of insurance against these kind of risks. They're called futures contracts, and historically they've allowed farmers a fixed price to sell their crops years in advance. The idea was to protect smaller businesses from seasonal price movements, giving them a degree of certainty about how much money they'd actually be bringing in each year. The problem is, these contracts also tend to fix an amount which farmers need to sell, and with immigration rules choking off farm labour, many simply can't deliver the amounts they promised. But even if a farmer can't fulfil their delivery, they still owe the buyer, creating a massive black hole in their budgets. The total value of agricultural futures contracts has now fallen by more than 20% since 2022, the steepest drop in over a decade. And at the same time, margin calls, that is, the payments farmers have to make when their contracts lose value, have quietly started to rise. In plain English, that means tens of thousands of farmers are now being forced to pay cash they simply don't have just to fill these agreements. And for many, that's been the final nail in the coffin. Projections now estimate that across the country, the nation could lose up to 100,000 farms by 2030. Now, as bad as it is for the nation to be quietly losing its supply of food, it still only makes up about 1% of the country's GDP. But the thing is, there's a huge risk that failure in this industry could be devastating for the companies which have been lending them money. When farms fail, the debts don't just vanish, they get passed up the chain to the regional banks, credit unions, and insurers that finance them, creating a cascade of losses that can quickly spiral out of control. That's a problem for lenders, who've poured over $450 billion into the sector. And this is part of a wider problem that has spread throughout the country and hits some states particularly bad. If you've made it this far into the video, you probably don't need me to tell you that America has a debt issue. But this is also across so many levels, particularly personal debt, record mortgage payments, and buy now, pay later schemes. And if there's one thing we know about debt markets, is that failure in one sector can quickly spread. A wave of defaults wouldn't just threaten rural economies, it could easily trigger a chain reaction through the entire regional banking system, reaching states that on the surface seem completely secure. Despite what you may think, many of the service-based states are actually some of the most indebted in the country. Places like Illinois, Massachusetts, and Texas now all have household debt to income ratios of over 130%. That's in large part thanks to the fact that for nearly a decade, interest rates were practically zero. At the same time, this seemed to make a lot of sense. After all, it allowed households, businesses, and state governments to borrow cheaply, refinance old debt, and keep spending through periods of slow growth. But it also made the level of debt explode. Between 2013 and 2021, total household debt across these states rose by more than 45%. But now that the era of ultra-low interest rates has come to a close, it puts the people who took on that debt in a very sketchy position. Monthly repayments were once manageable, have suddenly ballooned, forcing families to downsize and businesses to close shop. To make matters worse, it tends to be the states with the weakest social safety nets like Florida and Texas who have the worst debt problems. After all, if you can't get unemployment support while in between jobs, it's pretty much your only choice to take out debt. And these are the exact areas that are now seeing some of the sharpest increases in credit card and auto loan delinquencies. Of course, it's not like everywhere in the US is heading into recession. After all, the economy grew by around 3% in the last year, one of the fastest rates in the developed world. Almost all of that growth came from a handful of states who are at the cutting edge of the AI revolution. Places like New York, California, and Washington. Some estimates go as far as putting 92% of their growth down to the AI-related spending. But the thing is, even these states might be on more shaky ground than you would first imagine. While the AI growth has certainly been impressive, just like the service-based states in the low interest rate era, it's mostly fueled by borrowed money. Companies like Oracle are operating with debt-to-equity ratios of around 500%, meaning for every dollar the company actually has, they are borrowing 5. Even in normal times, that's a pretty risky strategy. The companies are banking on inventing a totally revolutionary and insanely profitable technology. But funnily enough, it might not even come to that. For financial services companies willing to hand out massive loans to risky AI startups, they first need to have a cushion of reliable income, money they can afford to gamble with. In normal times, these companies would raise their baseline revenue from mortgages, commercial real estate, and small business lending, steady, predictable sectors that keep cash flowing, which would give them some money to play around with on more speculative options. But today, those safe bets look increasingly uncertain. Mortgage delinquencies have risen to the highest level since 2008, and the same goes for small business defaults. For regional lenders, the reliable cash flows that used to fund everything else are now drying up. That means banks will now be looking for an easy way to pull back on risk, and the most obvious place to start is the AI startup sector, a crushing setback for the states that have spent the last few years riding the high of the tech boom. There's no question that on the surface, America's economic performance has been impressive. It's set to grow faster than any developed other country for the 9th quarter in a row, but it all seems to be based on a far more fragile foundation than most people realize. Decades of cheap credit, trillion-dollar deficits, and a financial system built on borrowed money have left it exposed to even the smallest shock. If the safe bets like agriculture and manufacturing start collapsing, the impact won't stay contained. It'll spread through the same financial channels that connect every bank, fund, and business in the country. It wouldn't be the first time this has happened. In 2008, it wasn't exotic tech startups or speculative AI projects that brought the system down. It was the most boring, reliable investment in the world: housing. Today, the setup isn't all that different. Only this time, instead of suburban mortgages, it's farm loans, factory closures, and tech companies built on leverage that could light the fuse. Now, I want to talk about one of Trump's key tariffs, a 50% tariff on copper imports. Trump is obsessed with copper. He views copper as 100% essential. It's not just a strategic metal, it's now an edge in geopolitics. Why the urgency? Copper equals compute plus defense. Control copper and you control AI infrastructure and defense production, a huge importance to this administration. Today, China dominates refining. We're seeing something we've never seen before. The government has even started taking stakes in copper companies in an effort to control supply chains. This truly is historical, and we don't think the market has quite grasped this. And that is why we're extremely bullish on copper, and in particular today's sponsor, Copper Giant Resources, ticker CGNT on the TSXV. This company owns 100% of the Macoa copper project, located in Colombia's Andean Belt, one of the most copper-rich geological areas in the world. The resource estimate is 2.1 million tons, which at 11,000 a ton is worth $23.1 billion, and the company is valued at $31 million. I'll say that again, 31 million. Obviously, all the copper is still in the ground, but the potential is absurd, and that's why the US has even begun talking with Ian Harris, the CEO of Copper Giant. And after the meeting, Ian said this: they want refined copper made in the United States, and there is a potential opportunity for Copper Giant to ship ore to the US. This is huge, and it matters more than ever now with policy, capital, national security, and Colombia's upcoming election cycles. And Copper Giant could be positioned perfectly to benefit from Trump's need for copper supply. Personally, this could be the #1 stock right now, and the timing couldn't be better. As always, do your own due diligence.